What are input tax credits in relation to the GST or goods and services tax? Input tax credits are an integral part of the goods and services system in Canada, as it is the entitlement to claim the refundable input tax credits on business purchases. This in turn relieves the particular business of the inputs of the goods and services tax and thus avoids the pyramiding of taxation. In order to qualify for an input tax credit, the goods and services must have been purchased for use in a commercial activity, not the final usage. As the goods and services tax is designed to be a tax on consumption to be borne by the end user, there are certain restrictions on the claiming of input tax credits. These restrictions generally mirror the restrictions on claiming expenses under the Income Tax Act. Input tax credits claimed by a registrant during a reporting period are subtracted from the tax collected on goods and services during the period to arrive at the net taxable payable. Where input tax credits exceed tax payable, the registrant is entitled to a refund. An important concept related to input tax credits is that purchases and sales need not be matched in order to claim an input tax credit. The credit can be claimed when the purchase is paid for or becomes due. Similarly, goods and services tax paid on purchases of capital property need not be amortized over the life of the property. Input tax credits are available where goods and services are purchased for use in a commercial activity. Conversely, if an input is not used at all in a commercial activity, no credit is allowed. A full credit is available where an input is used exclusively in a commercial activity. Exclusively is defined as all or substantially all and is interpreted by Revenue Canada to mean 90% or more. There will be circumstances where a purchase is used in respect of a combination of taxable and exempt activities. In these cases, except for certain capital property, registrants will be required to apportion the input tax credit between the taxable, including zero rated, and exempt activities. For example, consider the case of a hospital that purchases an industrial dishwasher for use in its kitchen. The dishwasher will be used to clean dishes from both the patients and cafeteria patrons. Because meals provided to patients are exempt and cafeteria sales are taxable, the hospital will be required to apportion the input tax credits between the taxable and exempt activities. The legislation does not prescribe allocation methods for use in apportioning input tax credits. As long as the allocation is reasonable and is used consistently throughout the year, it is likely not to be challenged.